My name is Eddy Benoit Jr., founder and CEO of the Benoit Group, and this is Shape the Deal. We will discuss some of the secrets and strategies in the real estate process that will help you shape your next deal. Welcome to Shape the Deal. My name is Eddy Benoit. I am your host today for the new episode where the discussion today will be on capital and equity investment. I'm joined by my guests today, Althea Broughton with Arnold Golden Gregory here in Atlanta, and also a good friend of mine, Collier, who is with Bridgeview Capital. So guys, thank you for joining me this morning. I know it is it's a Sunday morning. You could be doing so many other things, but I'm really honored that you took time to join me in this conversation as we talk to our audience here about some of the dynamics they need to be mindful of as they shape their deals, especially on the capital equity side. So this is a great opportunity for us to share some of these nuggets about the industry that people don't know that they really need to know. So Althea, I'll start with you. You tell us a little bit about how did you get into business? You know, you're not the traditional attorney that most people think when they hear the word, attorney.
Thanks, Eddy. First of all, I'm excited to be here. I'm glad you're able to share this knowledge with so many folks. So you're right. Most people, when they think of lawyers, they think of prosecutors, judges, things like that. I knew early on that I did not want to litigate, so I was looking for a path in transactional law. I kind of got into housing by accident, but met a strong mentor in that field and did a lot of development work that led me to the place here. But I've been a tax attorney, a corporate attorney, and I think all those skills help me be the best development lawyer I can be.
Wow. And Althea, I believe we've been working with each other at least a long time. We
A
don't want to say
long
how
time.
long it is. And same with, Kurt, but it's a couple of decades and a lot of battle wounds in between. Kurt, I think I know I had hair when I met you, back in the day. We were very young.
I had a little more too.
That's right. And so how did you get into business? Because I remember meeting you at Region Partners, and we were in our early 20s at that time.
We were. I think I was in high school, and you were. Yeah, we were in our early 20s, and I was a banker at the time, as you recall.
First Union,
that First Union, and we were working on a deal together, and that really feeds into really the path that I took, really to become an entrepreneur and self-employed in this field. Is I let corporate America teach me. Coming out of school with a finance degree, I got into a very good management training program because I wanted to go into commercial real estate, but I didn't really know much about it. As we discussed before, growing up, my experience with real estate with professionals were people who sold houses. And I didn't know, that it extended beyond that into so many other different industries kind of within the larger commercial real estate industry. So I let corporate America teach me and show me kind of everything that was available in commercial real estate. And so I'm working, I think we worked on Tower Place 200, if you remember that deal.
That's right.
That was I can still remember that loan. That was a $30 million loan. That was 25 years old building it, and here you walk in with David Collier, and I'm like, okay, this is a brother that's building a deal, and so I was impressed, and I think that, I spent the next 10, 15 years after that kind of continuing to grow my network in commercial real estate, and then when the recession hit in 2008, I did something really important that I would like to focus on, is I took a risk. I'd saved money. I'd built a network, I developed a knowledge of the different industries, and I decided to go out on my own and try to I principled some deals starting out, and then later on I started raising capital on the debt side and on the equity side for commercial real estate deals, and so here I am now.
Wow. And you went to Penn, right?
I went to Wharton UPenn, yes.
And where'd you go, Althea?
I went to University of Virginia for law school.
Okay, UVA, and I'm a University of Florida, guy myself down in the South. And for me, I've always wanted to be in the commercial real estate development business. I would ask you, Kurt, when you're underwriting a project and you're looking at whether you should invest capital in it or not, what are the key factors that you look for, with that sponsor, that developer?
So first of all, I want to qualify that investment as I see it, it could be either debt or equity, right? So investment is when people are sending money out and they expect it to come back, right? So so this would pertain, I think, to both, not I think, but it would pertain to both equity and to debt. But the first thing that I would highlight is that it all starts and it stops with people, getting in bed with the right people. And we've all heard that, but you've heard the old saying that I've heard said and I've heard many times in the industry: if you can invest in a good deal with a bad person, and you will have a bad investment, right?
That's right.
And so, you know, to go a little deeper with that, then, you know, starting with people, but those people have to act with integrity. They've got to be honest. Unfortunately, we live in a world where there are too many people who don't do what they say they're going to do or misrepresent things. And as we all know, that those are recipes for bad deals and bad investments. Then beyond that, what I would look for is, does the deal make sense? When you're underwriting the deal, you know, let's take an apartment project, for example. If someone says they're going to build an apartment project, do the rents make sense, right? If someone says, I'm going to build an apartment project in Union City and it makes $10,000, you know, it's going to lease for $10,000 a month, that doesn't make any sense, right? And
that's what they like.
You know, that's an extreme. That's what they would like to have. And a lot of pro formas, you see what people will put on there, what they would like to have or what they think could have, right? So you got to do your market research and your due diligence there. Then from an equity and debt perspective, you know, you look at, you know, if the deal makes sense, is it going to generate enough money to give you an appropriate market return? Right? Yep. Or for a loan, an appropriate coverage, right? Will it provide an appropriate debt service coverage? Or as an equity investor, will I invest money in will this project make enough money so that I can get an appropriate return on that investment? So those are the things that I would highlight there.
It's very interesting, and especially with that debt service coverage, most people, you know, don't realize that that is a very important factor in the underwriting process, just to make sure that there's enough cash flow, profitability in the project itself, you know, based on some of the assumptions that are being made, and also what the true market dynamics are. But you're right about that, you know, Kurt. You know, today in this business, we continue to talk about, you know, risk, and we talk about some of the challenges that the investor and even the attorney has to deal with at the infancy of the deal. And so I know many times out there we are talking about the deal in the ideation of it. I'll call you and say, this is what I'm thinking about. It's never been done before. I'm like, hey, are you sitting down? And you're like, okay, Eddie, all right. Okay, where are we going? But Althea, how many times do you find yourself having to advise a client not to do a deal that they're so enamored with and believe it's really a great deal?
Now, that's a great question, Eddie. You know, it's interesting because I think lawyers have a certain set of risk tolerances, which I think is why we're all lawyers. And I think developers have a different set of risk tolerance. So I think usually in my conversations with developers, it's not so much I wouldn't do this deal. I feel like my job is to actually say, are you aware of these risks? Lay them all out. And then say, are you comfortable with these? Or what happens if this particular thing goes wrong? Are you prepared for the consequences? And I have that conversation very frequently with developers, because developers, a lot of them have visions, they're excited about the project, they want to do something great. And I feel a little bit like, you know, the bearer of some bad news, like, well, what happens if you can't get this easement? Or what happens if you don't get this funding? Or what happens if your site control goes away? I mean, and so many times it's just really listing out the risk factors. And I will tell you, the really good developers actually have thought about it and they have a plan. And so then it's a much more interactive conversation around, okay, if this happens, we're going to go to plan B, and then this should fall into place. So it really is making sure that the client has understood all of the risk factors around the deal, not so much saying you can't do this deal or you shouldn't do this deal, because, you know, risk is comparable to reward. And so the reason you are a developer, you're taking those risks, you're making those returns. So you've got to take risks. The question is, are the risks manageable and do they make sense?
Well, I tell you, you know, in your interaction with these other clients, these other developers, I guess, you know, that's what you lay out to them. What I hear on the other side of the phone is like, I don't know. You know, really, Eddie?
Yeah, no.
You sure you want to do this?
Yeah, that's pretty much it. Yeah, if I go, okay, okay.
Yeah, the okay, yeah, all the
okay.
okays.
If you hear a series of okays, you know I'm like, that's some risk right there.
That's a risk, that's right. So, but that's very important because that's a tough position to be in, you know, especially as the attorney. Trying to get into the deal dynamics itself as opposed to just the legalese of the transaction. And so that's where, you know, Althea really brings a different edge just from, you know, just her counsel on the deals, because she's there with us, like I said, as we're going through the ideation of the transaction, before we even look at a structure, before we even come up with the name of an LLC. All of those things are just, you know, post facto. Let's play this deal out all the way, and all the different pitfalls that we may have to overcome to even have a deal that can be presented to you, you know, in your group, you know, as a capital, you know, investor in the transaction, or to even present to a lender, but that could even go through the due diligence process. And so we definitely, you know, embrace, you know, that kind of engagement. With, you know, Althea and her group, and that is, you know,
I think that's really part of my job. I mean, you know, a lot of people look at lawyers as just, oh, can you just write up this contract, or can you just do this deed? But I don't think I'm providing really great legal service as a counselor unless I'm aware of the market dynamic, governmental risk, you know, building relationships that really help bring your vision into being. So if I can't bring intelligence like that to circumstances you're trying to achieve, then I don't really feel like that's, you know, full service legal assistance.
Yes, and you know, most folks that are going into the legal, you know, field, whether you're in college or looking to get a terminal degree, they've already been in the workplace. They think of just being an attorney, being a lawyer is just, again, being a prosecutor, a litigator, a criminal defense or whatnot, and they just don't really know that from a transaction standpoint, how much you really have to know outside of just, you know, putting the contract, you know, together.
They are integral parts of the team.
Oh yeah, integral part of the team. You know, so as it relates to the borrower, the developer in this case, which from a capital standpoint, that would be your partner, because you'd be the limited partner and there would be the general partner, which is the role that we play predominantly on all our deals when we bring in a capital investor to co-invest with us in the project. Do you have to like this person? You know, because people a lot of times miss the fact that, you know, they're asking for money based on their dream, their passion, their project, and they're like, you know, Kurt, can Bridgeview Capital invest $20 million in equity in this deal? The deal pencils out, but do you have to like that?
That's not a loaded question, I know, but we've done business together. I don't really particularly like you,
I
so
understand, but, you know, I mean, but I know where to find you. I know where to find you.
You know, the short answer is no. You know, and that might surprise you, right? And I guess it depends on what you mean by like, right? I mean, you don't have to be best buddies with people, right? I mean, I've done business with many people that, you know, we voted for different candidates, or maybe we, worship different gods, right?
Yeah.
And so, you know, we're not bosom buddies, but I think, you know, if I had to restructure your question and maybe still answer it, is, you know, you don't have to be bosom buddies, you know, with a client, with a borrower or a developer, but there are certain things that you do have to appreciate, and I think that there are certain characteristics that have to be there for me in order for me to invest in you, in order for me to do business with you, and that is, and I touched on this before, you have to be honest, you've got to operate with integrity, but also the things that makes it better, or makes it a better experience to work with someone is, you know, if I work with, to use the term, hustlers. I love working with hustlers, especially if I invest with them, right? Because invariably, you know, as a developer, that it is a very fluid process. There are tons of variables, invariably something is going to go wrong during that development cycle, right? And you don't want someone who's going to not communicate with you, stick their head in the sand, disappear on you, you know, back down from a problem. So there are characteristics that I think need to be there, but do you have to like them as a friend? No, you don't.
Yes, and I'm glad you answered that way, because most people believe that you have to have, you know, personal relationships with, you know, certain capital investors in order to get them to invest in your deal.
And I do.
Yeah,
I do,
and
right?
that a lot of times the relationship is really opening the door as far as getting an introduction, whether it's done by you, Althea, somebody that I know. Hey, want to introduce you to Kurt Collier here, and but beyond that, you know, unless there's some issues related to my personality or character, my background, you asked for some references, they've come up negative, you're going to underwrite the deal for what it is. And you're also going to look at the experience factor.
Yes.
Okay, as far as is this their first rodeo, the first deal that they're doing? How many deals that they've done before? And you want to hear about, you know, the stories as far as the failures and the successes throughout, because that all, you know, adds up to the overall experience factor for that partner, because they are going to be your partner.
Yes.
In this situation, you're not lending them money as a lender. You're investing with them. So you get to feel, you know, the cyclical nature of that project until it actually is completed and is financially feasible.
If I could add to that, and I agree with that 100%, you know, and I think what you're saying is you need transparency with people. Right. And so many times I feel like, or too many times, I feel like I have maybe talked to someone I've considered investing with, maybe raising debt capital or investing equity capital with, and you feel like they're withholding something. I'm sure you've come up with that as well. Yeah. And a lot of people, they don't, you know, you don't want to jump into a $50 million deal with something and then figure out that there was a skeleton in the closet that someone really could have brought to the front, you know, in the first month of getting to work on that deal, and it comes out 6 months later and it potentially implodes the deal.
It could have been addressed early on.
Absolutely.
Exactly. You know, early on, and figure out what the mitigators would have been. You know, there's a lot of, you know, mistakes that are made, you know, in the negotiations of the limited partnership agreements, and pretty much it's kind of like the holy grail of every deal. And every time you have to go back to that document, that means like, something's wrong. Something's wrong. Let's go back to that document.
When I find myself looking,
you know, 100-something pages, and you're like, okay, how do I get to that? And you're down to this one paragraph, and you're down to this one sentence, and now it's a matter of interpretation.
Right.
Yeah.
And, you know, Althea, you know, how many, you know, what are some of the common mistakes that you see, you know, developers, you know, make in these limited partnership agreements with capital investors that are repetitive?
Sure, Eddie. I mean, I think to the point that Kurt made, your capital, that's like a relationship. And you want somebody who trusts your capabilities, trusts your abilities to perform, and invariably something will go wrong. But, you know, what I'm seeing really is initially a lot of people look at a term sheet. So you'll get an LOI. And it'll have a couple of basic points. But what I see a lot of developers doing is, if something is important to them, they're not raising it at the LOI stage. If it's really important to you, you need to be saying up front when people are quote unquote courting you, when they're sending you those LOIs, you need to say, it is important for me to get X. It is important for me to, you know, exit this way. It is important for me to get this type of distribution. So, you know, early on, make sure you are explaining to whoever your capital partner is what your wants are and getting them memorialized in an LOI. I think the other thing people don't think about really is just the exit strategy. You know, I actually participated on a panel a month or two ago where there was a developer, there was a equity investor, there was an accountant, and the equity investor essentially said, you know, don't worry about the exit strategy now, we'll figure something out. And I was like, no, that is not what you do. You know, what you want for your client is to actually know what your exit strategy is and how that gets memorialized in the documents, so that when time comes to exit, you are actually executing on your plan or you have leverage so that you can go and get a better deal for yourself. So sort of, pretending like things will be fine at the end, things change, people change, environments change, and markets change. You need to make sure you're covering all those eventualities in your documents. The other thing I think of is just, for me, those documents are a matter of making sure, the developer has the control that they need to do what they need to do. So you don't want to check in. No disrespect to investors, but you don't want to have to check in all the time to do things to get your project moving forward. So that's why it's important to have a relationship of trust so that you're not spending time going, okay, can you approve this change order? Oh, can I go get this easement? Oh, we want to distribute this money. Oh, we need to pay this fee. It really should be, here's our money. We trust you to do a good job for it. There are certain guardrails, obviously, but developer, move forward, build the project that we expect you to build.
I definitely agree with that.
Can I add one thing? Because
as the investor,
I have to.
Right.
Even as an investor, but just working on so many transactions on the lending side and on the investing side over the years, and I know you'll agree with me 100%, both of you will, is that you will never come up with an operating agreement or a loan agreement that is going to cover every single scenario of something that could possibly go wrong, right? The attempt is to try to cover a lot of them, but invariably something is going to happen that really you don't really have a guide to an answer to in the operating agreement. And so that is where, going back to your earlier question, though, I think it is imperative that not necessarily that you like the people, but that you have a good working relationship with them. Right? Because you have to be able to negotiate and work through and communicate through problems as they will come up if you do not have a roadmap and the documentation around that transaction.
That's true. And you talk about the LOI stage, which is the letter of intent. For us, we make sure that we look at that as the point of entry in the deal. So we're very anal about the terms, as you know, in that document, even though it's non-binding. But anything that needs to surfaces at that time, because as we focus on our entry into the project, we're also focusing on our exit of the project. So the terms of that letter of intent, the LOI, cover both stages of the project itself. And the devil is always in the details, as you know. And most developers, whether new, young developers, experienced, they're so excited about the project, the transaction, they can't wait to put a shovel in the ground, that they're like, okay, we'll deal with that later. Oh, we'll be okay, because they want the money. Yeah. How quick can I get this commitment and fund? And you can get a commitment, but it still has to fund that closing.
Right.
So just because somebody signed on the dotted line, Kurt says, okay, everything, we've done our underwriting and we're ready to move forward. And you get to closing, pre-closing, to find out some of the things that were misrepresented, you're not going to fund.
Right.
That's right. I mean, I think you make a point. Just like, developers have reputations, investors, capital, they have reputations too. You want someone who's going to be able to fund quickly, to do what they say they're going to do. And you want someone who's not, quote unquote, a vulture fund, someone who's not trying to take over your project if you have a misstep, which goes to Kurt's point about the relationship.
Not just your project, your company, or your
yeah.
personal life,
your house,
yes,
right.
everything,
right.
Yeah, unborn children, your grandchildren. That's right. I'd like to move into another topic, which deals with, the deal breakers. What are some of your deal breakers in capital investment? Kurt.
So if, with respect to kind of the way the deal is structured, I would answer this from an equity standpoint. If there are issues that come up that unfairly shift the risk from the sponsor or GP to the LPs, or unfairly shift the profitability or the remuneration to the LPs, those are typically the deal breakers, or also control provisions. And I know I heard Althea say earlier about, you don't want your you don't want your sponsor going back to the investor and having to get everything
Signed off,
okay,
approved,
signed
yes.
off, approved, etc. But let me give you a scenario, right, Eddie? If you bring me a development deal, let's say you bring me a $20 million development deal, you need $10 million of equity, $30 million in total, and I put all of that $10 million up into the deal, or we do a 90-10 deal, you know, but I've got the controlling amount of equity in that deal. Guess what? I'm gonna tell you what to do, right?
That's right.
It is, you know, if you have a limited amount of equity in that deal, it's it's my money that's at risk. So, so now that doesn't mean I've got to pick out the doorknobs and, you know, in the types of refrigerators that you put into the unit. But for a lot of the major decisions on, you know, when you decide to exit that property, whether you decide to refinance or sell it, I'm going to have a say in it. And
all
so,
consequential decisions.
Absolutely,
You want to
absolutely.
pretty much have a say in that.
And so, and I know Althea will agree with me on this, right? But but she's just got to document it that way, right?
Well,
if she's working for me.
I'm going to push back a little bit on Kurt just for 2 seconds. And so really it is about, you're right, it's the investor's money, but the GP is the sponsor. And
Yes.
so, you know, you're right, there are certain major decisions where the investor,
Yes.
major, sale, refinance, big ones, get that. But a lot of the, you know, sometimes you'll have forms that'll come through. Notwithstanding the fact that people have a great relationship, you'll have an operating agreement or a partnership agreement that will come through, and it will have language that you're just like, this is not very partnery. Like, why would I, you know, and maybe that's the form they start out with because, you know, when people show up and they say, don't worry about it, they've got a form that's been drafted by their lawyer that's going to have provisions that are favorable to them. So what I'm trying to do is clear the path for Eddy. I mean, I'm trying to clear the path for my client to make sure they can, in fact, do what they can do. But you're right, there are some controls, there's some guardrails, but I am constantly pushing back on, you know, you picked Eddy as your developer, you've picked Eddy as your sponsor. Let him do his job, because that's how you get the project built, and that's how you get your returns.
I agree with that 100%, and hopefully you didn't mistake me as saying anything to the
No,
contrary.
we're good. We're good.
Because agreed, you know, as an investor in Eddy or another developer, you're right that capital is limited, you know, and by definition, you know, that limitation really extends to I'm putting my faith and trust in this developer to do what he does best. I don't know anything about doing site work on a project, right? I'm hiring you, or not hiring, but I'm investing you in this project because I know that you're the person that should be able to get this done right and build this project the way it should be built, right? So now backing up also, now I've seen, and usually this comes out in the LOI stage, but another deal breaker is I've seen deals kind of put together where they're exorbitant fees to the sponsor or the GP, and so I typically try to stay away from those. Where you have development, and I know you would never do this, but I've seen developers put together deals that are trying to basically make their money on the front end.
Strip cash out. Yeah.
They're stripping it out. It's another interesting topic I'd like to get your viewpoint on. Is related to just the access to capital for minority businesses, women-owned businesses, African-American-owned businesses. You know, there continues to be just a disparity in the access to capital for projects just along the entire spectrum of commercial development. You know, what is your view on that today?
You know, I have a lot to say on this, and I would say in general it has improved. And I think you and I started out in this business around the same time, and there were not too many people who looked like us on the principal side, let alone even on the services side where we were all working. So I think that has improved. I don't think it's improved enough, but it is. In terms of access to capital, and I'm going to try to keep this short, when you look at, I think there are kind of two different types of ways to get deals done, right? There's one type of deal where you go to capital sources that are very quantitative, right? And I'll say, like the agencies, for example, right? If you happen to have or able to acquire and get the equity to acquire an apartment project, if you go to Fannie or Freddie or HUD, it's very quantitative in that if that deal fits, you're going to get the money, right? It bar, some other circumstances, some other qualitative circumstances, if that deal fits. And to a large extent, I'm sure you can attest, the low-income housing tax credit program, right? It's a very quantitative program where you're scored, your applications are scored for eligibility based on a lot of different criteria, and you got to kind of hit those boxes. Yeah. And so historically, we've seen minority owners and developers really go into those areas because it's easier access to capital. Now, I came up in the more subjective underwriting world of construction financing for conventional projects, acquisition financing for conventional projects, and let's leave equity aside for now. But those types of projects were very subjective, the underwriting. Mm-hmm. It's almost like who you know, what kind of relationships you've built, right? Do people trust you? And it's, I'm gonna say something that, in order to get that capital, it's, I would give the advice that, we've probably all heard from our parents, is that when you see black developers, minority developers come in and try to access that capital, you have to be better. You do. You cannot come in and be sloppy.
You cannot be equal.
You cannot be equal. And I hate that it comes out that way, but that's, quite honestly, that's advice for anyone looking for capital, minority or woman or white males. Be better, but you can't come in, as you mentioned, if you have holes in your resume, gaps in that presentation, if you haven't done a good market study or understand the construction numbers or understand the underwriting of the project, you can't have holes. If you don't have a guarantor, you better go find one. If you want to go borrow money from a commercial bank to develop a deal. And the bar is higher. It is. Maybe not as high as it used to be, right? Probably 40 years ago, there wasn't a bar at all. Do not apply, right? There wasn't. Let's be real. There wasn't. But today there is a bar, but it's set a little bit higher from the rest. So I'm being real. I think that's what this show is about. But that's right. My opinion.
People really need to understand that it's not a matter of just putting a pro forma together. Oh, by the way, I'm just going to get a loan because I believe in this pro forma, and I don't have any hurdles to overcome.
Yeah.
Althea, from your end, from the legal side, when you look at some of these partnership agreements, do you see any disparity based on some of the requirements with different types of companies, whether it's minority-owned company, women-owned business, or just a predominantly white, owned, company?
So, great question, Eddie. And what I will tell you is, and I think Kurt alluded to this, access to capital is a function of relationships. And so you will see, quite frankly, white developers have stronger relationships and get different terms than minority developers. And you'll see that when you're having the negotiations, you'll see that as the negotiations are moving forward. And so you'll have a conversation with your client and you'll say, I see these 4 issues in your document, these are things that we'll need to address. And then so we'll have a little pre-call, and then we'll have a conversation with the lender or the investor. And sometimes the outcome and the approach of the lender and investor is very different based on that relationship. So Kurt's right. I think you cannot just think you've got a good project that pencils out on paper. It's always a function of relationship. And where you may not have the strongest relationship, you just have to make it up in quality of everything else. And that's the push you have to make. I do see, now, in the past year or so, more and more funds trying to get dollars out to MBEs and WBEs, but that's a relatively recent phenomenon.
Yes.
And I think Kurt's point is dead on. I think the reason why we see so many minorities concentrated in government-sponsored or government-funded, GSE type programs is because it is not so much the relationship, but just the profile of the project itself.
Interesting. Well, this has been some, good discussion here. I mean, we can go on and on, as you know, about this this topic. But I would love for you to leave some takeaways, for our audience. Just what would be the top 2 or 3 things that you would want them to adhere to as they're shaping, their deal. Althea?
Sure. Okay, so not a commercial for me, but get your lawyer involved early. Because your lawyer, if you have a good relationship with a lawyer who's really, knowing what they're supposed to be doing, they're going to give you insight on market, they're going to give you insight on deal, they're going to give you insight on structure, and not just paper whatever you want them to paper. So get them early on so you can sort of mitigate the risk. Secondly, I would say, build the relationships that you need to build to get your projects done, and that's going to take time. So, as you put your deal together, ask questions, meet with people, meet with several people, meet with different capital sources, and ask them difficult questions, because that's the way that you'll get to understanding how your deal can be put together.
Right. Kurt?
Well, Eddie, the takeaway that I would like to leave to the viewers is your most valuable resource, the most valuable resources, as you're pursuing a deal, are your time and whatever limited capital you have, right? I had an old client tell me something I never forgot. He said, the best deal that I ever did was the one I didn't do. You have to manage that time and your resources very judiciously, because if you waste them and you put them in the wrong deal also, it could be catastrophic, right? If you go and chase and by happenstance you get that deal done, and it's a deal that shouldn't be done, it can take you out. It can take you. It could be catastrophic to you financially. So
there's a fine line between persistence and forcing a fit.
Yes.
And what you don't want to do is force a fit.
So I really appreciate you guys joining me again, today in this discussion. You've been very successful in your careers and continue to be titans in this industry. We've had great working relationships, together over the decades, and looking forward to even more. I know we can talk about a whole lot of stories, and we just don't have enough time. But I am also grateful for the information that you've shared today with our audience, and that is going to be very important for them as they continue to shape their next deal, which is what this show is all about. So thank you, guys. I'm looking forward to doing business on some other ventures. All right?
It's our pleasure.
Thank you very much.
Thank you.
All right, Kurt.